Welcome to Bonfire the Currencies. We're very happy to have Jim Grant here today. Jim's an old friend of mine, and I'm sure you all know who he is, maybe the most famous IU grad around. We've all read, especially in our class, we've all read his newsletter for a while now, and he's gracious enough to do that to us. And he's got great insights. I encourage you to continue to read it, and let's hear what he has to say. So, Jim Grant.
Thank you, John, and what a pleasure it is to be back. John didn't mention this, but I am an alumnus of Indiana University Arts and Sciences in the year 1870. What John also didn't mention is that I am responsible for John being here, and John's responsible for my being here, which requires some explanation. The year was 1998, was it not? Yes, and we have two conferences a year at Grants. And this was the, I believe it was the spring, spring, yes, it was a day like this. But for John, it was not quite so charming. John got up and proceeded to give a fabulous speech on the complexity of derivatives and on the difficulty of managing derivatives and the people who trade them. John at the time was for a firm, perhaps you've seen this firm in print, you have not visited it recently. It being a casualty of our sorrows of 2008, it's called Lehman Brothers. John was in charge of a book of derivatives business at Lehman, and John, it's a good thing he's back where he belongs here because he is an inveterate truth teller. And John looked out into the Grant's audience of sophisticates and investors, and he said, do you know, he said, that many people have no idea what they're doing with derivatives. And furthermore, the people who supervise those people have no idea. Even at my firm, at Lehman Brothers, my boss has no idea. Now, the cell phone age had not become so miniaturized as it is today, but they were small enough to be portable. And I could see trouble coming, John, because in the front row, I saw 15 or 20 people reach for cell phones and discreetly, or not so discreetly, say, hey, is it true that Lehman has no idea what's going on in derivatives? It turned out that Lehman had no idea about many things, but that suddenly was the end of one phase of John's career and the launching pad for many greater phases. So you can thank me later, John. So that's full disclosure on our interpersonal connections here. Okay, MBAs to be. Let's get down to cases here. I want you to do some mental math. You've all heard of the rule of 72, right? To find the doubling time of money, divide the interest rate by 72. You're there? Okay. So I'm going to propose to you that we live in an age that is perhaps unique, certainly in the monetary annals of money. Every currency is faith-based. Every currency is pure paper. Fiat is the term of art. We have had intervals of fiat currency from time to time in the history of modern money, but never until 1971 to date, an era in which every single currency was nothing but pure paper, and in some cases hot wind backing the pure paper. This is by way of preface to asking you to by way of introduction to this topic of monetary affairs and how to invest in a time of monetary turmoil, this is by way of preface of inviting you to appreciate the power of compound interest. It seems to me that the compound interest and the appreciation of its power is the first step to a proper approach to a life of investing. So I'm going to ask you to take yourself back to the death of Cleopatra. Now, according to no less authoritative a source than Wikipedia, Cleopatra died in 30 BC. So I'll go with that, 30 BC. Now let us say that the heirs and assigns of Cleopatra had the generosity of spirit to convert $100 worth of her gold bangles and baubles into a certificate of deposit at the Bank of Eternity, a perpetual 2% CD at the Bank of Eternity. Okay, so 2% compounded annually from 30 BC today. No, don't do it. No, I'll do it right here. Okay, so carry the 6 Okay, so the number I come up with is 36. Yes. 18 integers following the number 36, separated by 6 commas. That's what you get. An unwieldy number. So let's bring it down to earth. Let's divide 36, comma, et cetera, et cetera, et cetera, by the world's population, which again, according to the same unimpeachable source, Wikipedia, is 7 billion. 7 billion divided into 36, many commas and zeros. Yes, I've come up with the answer. It is $5,207,364,874.46 per capita. 5.2 billion per capita on the face of the earth for 2% from the time of Cleopatra. I mean, was it so little to ask of these ancient Egyptians they do this? What a very handsome gift it would have been, and how thoughtless that nobody thought to make it. Of course, there were difficulties. For one, the Bank of Eternity actually did not exist, and as students of John Succo's, if you're paying attention during the fractional reserve session, you understand why the Bank of Eternity does not exist. I'm not saying it wasn't chartered. I'm just saying it doesn't exist. So the bank doesn't exist anymore, and more to the point of my talk, neither did a perpetual currency. So I hope you'll accept on faith my historical assertion that history is discontinuous. Nations, empires, banks, and currencies rise and fall. Gold endures, but a lot of good that does us. Seekers after an easy 5.2 billion per capita, you see gold pays no interest. And by the way, neither does the Ben Bernanke dollar, which is another subject. I'll get around to that around 7 o'clock tonight. So what's wrong with currencies is the first order of business on my agenda today, and a prescription for setting things right is the second. In preview, the trouble, that is the essential trouble with our monetary organization, is a worldwide neglect of the price mechanism, in my opinion. Adam Smith might well roll over, but our central bankers show an inexplicable preference for the brute methods of command and control over the delicate and coordinating interplay of market forces. Have you ever thought about what they do at the Federal Reserve Board? We take it for granted. It seems second nature now. I got out of school in 1970. That was the last full year of the Bretton Woods regime, under which the dollar was defined as a fixed weight of gold, $35 to the ounce. 1/35 of an ounce of gold was the definition of the dollar. Since then, since August 15th of the next year, 1971, the dollar has been free-form, free-floating, uncollateralized, undefined, and sadly not unscored upon. The Fed is in the business of what? It sets interest rates, but does that not strike anyone here as anachronistic? Why do we need a central agency to set interest rates? We have these things called markets. Why aren't money market interest rates set in the marketplace? Why does the European Central Bank feel it is incumbent on it to give away the better part of $700 billion, which it did early this morning, at 1%? Why does it set that rate? Why can't it let buyers and sellers get around to doing that? So a theme of my presentation to you is that we live in an age of anachronistic command and control in our monetary affairs. The gold standard, to which I am partial. In fact, I'm not sure if you know this, I don't mean to brag, but Ron Paul is going to make me his Fed chairman when he gets to be president. Yeah. Now, he's a few percentage points away, and I therefore am not selling my house yet, but it comes to that, I certainly will serve. Ron Paul's idea is that there ought to be some tangible collateral behind these pieces of paper we call currency. That was the idea of the founders of the country as well. It was the idea of every banker of note, or even of not note, for many hundreds of years. That was writ, it was orthodoxy. For 41 years, we have been on a new course. If the every man and woman a multi-billionaire project failed to take root in 30 BC, it's a cinch it wouldn't catch on today. Our currencies are good for a trade, but none to me seems ripe for a long horizon investment. In fact, I suspect that monetary historians will look back on our time as a kind of a dark age. Having been out of school as long as I've been out of school, I've come, at least for my, I've satisfied myself that a useful thing to do as an investor is to try to imagine how posterity will imagine the time in which we live. When I got out of school, people seemed to think that it was natural and prudent that the dollar should be defined as a weight of gold and that other currencies should be exchangeable into dollars at this given statutory rate. That idea has been entirely swept away. It's astounding when you review history how quickly these seemingly permanent ideas are, how transient they can be. So I say it's useful sometimes to, when undertaking an investment, especially one that is meant to be for the long pull, it's useful to think, to imagine what they will think of us. They'll find our eyewear peculiar, our haircuts droll. They will wonder why we dressed as we did. But what will they see that we can't now see about the age in which we live? That, to me, is always a useful question to ask ourselves about investing. So, as I say, I contend that this will be seen as a dark age, will be seen as an anachronistic age in which the methods of central planning have supplanted those of central banking, and that people will wonder why we put up with it. As an advocate of this seemingly fanciful idea of return to a gold-backed currency, people are saying, isn't this something out of yesteryear? Isn't it? We aren't using sextants. We're using global positioning systems. We don't use cutthroat razors. We use the disposable kind. We don't. We like email. You don't have stamps on email. We move ahead technically. We don't look back as a general matter in society. Certainly in material things, we don't look back. Progress is cumulative. Why this preoccupation of yours? They address me and others like, why this preoccupation with what has come before? And my response to that is that in finance, progress is cyclical. As we seem to relive the errors and the triumphs of our forebears, whereas in science and technology, progress seems to be cumulative. We stand on the shoulders of giants, as they say. So I contend to you that we, inescapably in finance, must be students of history because we are bound to live with some variation, of course, because the historians can't tell us what's going to happen. We are bound to live out to some degree the experiences in the past. That's why it has always struck me that reading history and thinking about it is a useful thing to do. So, a dark age, I say. Certainly it's no sign of enlightenment that governments and their so-called independent central banks are suppressing interest rates, manipulating yield curves, and debasing currencies. And in the United States, the Fed is trying to raise up stock prices. That's by way of preface, and I want to tell you about some of the things I propose to cover in the next 3 hours. It's a joke. I would like to tell you a little bit about, I want to make a bullish case for houses, for single-family residential real estate. I want to tell you about a stock that will make you rich. That's later. And I want to talk about the clear and present danger we see from China and the cycles in interest rates. Those are the principal subjects under discussion. And then finally, I guess I will conclude with another few words on world monetary affairs and talk about these inflammable currencies of ours. So I want to begin this series of topics with interest rates, of which we used to have. We used to have interest rates. And boy, do I ever miss them. You know, my publication is called Grant's Interest Rate Observer, and no one's getting any younger. I can't see interest rates anymore. They're tiny. When you stare at the page, you cannot make them out on the page. They're like zero. Little tiny 6-point type interest rates. It's not good for business. So I am somewhat compromised and analytically. I need interest rates for a livelihood, and they're not giving us any. Never before in modern times have rates been lower, and never before have central banks been easier. And on these two extraordinary circumstances, I think, you will launch your careers, and you'll look back and you'll be so glad I told you these things, because you will now be able to appreciate what it is you have in front of you and what it is that you'll be pushing against. There is a curious cyclicality to long-term interest rates. In fact, there's a book on the topic with the scintillating topic of the history of interest rates. It's written by Sidney Homer. And in this book, Homer shows that long-term bond yields have tended to rise and fall at intervals of about a generation, quite uncannily. They fell, did bond yields, from the years 1870 or so till 1900. They rose from 1900 to 1920. They fell from about 1920 to 1946. Then they rose for the next 35 years till 1981. And they've been falling from 1981 to date. And I want to tell you a little bit about the characteristics of the turns at these cycles. The year is 1900, and the insurance companies are starving. Long-term bond yields are about where they are today. They're at 2%, 3%. In something like desperation, one of the presidents of one of the leading insurance companies that necessarily needed interest income to pay its policyholders, in something like desperation, the president of this esteemed company wrote to the leading authorities of the day, people like me, people who know the future before it happens, and asked them, where are interest rates going? And you know what they said? To a man, there were no women, such was the darkness of that age. They said that interest rates are going down forever. Now, class, that is called muscle memory. And it is a very important and very importance of which is unrecognized in most financial textbooks. Muscle memory. That is to say, one's immediate preceding vivid experiences in investing program one's perceptions and one's imagining about the future. So interest rates had been falling for 30 years. Railroad bonds have been called away. Nobody could make a living on as a creditor. It was 1% had a very difficult time in the year 1900. Okay, so the cycle turns, just like they said it wouldn't turn. Just like they said it wouldn't, it did. And interest rates proceeded to rise until 1920. Well, what happened over those 20 years? Why would rates have risen? Why would rates have fallen in the preceding? Well, rates had fallen because the world was a place of material wonders. The Suez Canal had opened in the 1850s. Suddenly transportation had been revolutionized through steam power, through the railroad. The telegraph had revolutionized communication. Productivity growth, leaps and bounds did it proceed. Can you imagine the growth in productivity, output per worker hour that would have followed from the introduction of the electric light? Astounding, astounding. And people knew it at the time. They knew it. There was a deflationary undertow in world affairs. Prices declined over those 30 years at about 1.5% a year. Now, was that deflation or was that progress? Well, it was progress. It was deflation in the sense that prices dwindled, they settled lower, but the reason they fell was because the world was getting richer. So, comes to 1900, still material progress is in the wind. Indeed, it's in front of one's face. But for some reason, interest rates now ratchet up, and then comes World War I. Great inflation ensues. The world suddenly exits the gold standard, 1914. No more gold standard, governments borrowing heavily, central banks printing like mad. Interest rates go up. Big inflation. That ends with a deflationary collapse, 1920-21, Big Depression. Interest rates proceed to fall through the 30s to 1946. The year now is 1947. Interest rates had bottomed at 2.1% of the long-term U.S. Treasury bond. A big oil company is going to sell some debentures to the public. It's going to raise like $50 million, a lot of money then. It's going to charge 3% for 30 years, meeting of the underwriters and the principal investors. You know what they were worried about? They were worried about the covenants and the legal language in the bond indenture that would guarantee the senior claimants a place at the head of the queue of this company's assets in the event of bankruptcy. This was a AAA company. And what the creditors were worried about in 1947 was credit risk. You know why? Because they had lived through the Depression. Again, muscle memory at work. What they should have worried about, with just a little bit of clairvoyance, was the next great event in America, which was the post-war prosperity and the coming inflation. But they didn't, because they, like we, were human. So they worried about the last thing, not the next thing. It's an occupational hazard. When you look back on it, it's a wonder that anyone sold any bonds at all, what they did. 1946 saw the passage of something called the Employment Act, which for the first time obliged the federal government to take responsibility for the full employment of anyone wanting and willing to work. That is to say, the government was in the business of stabilizing the cycle, of, through fiscal and monetary policy, of forestalling anything like the depressions of yesteryear. That seemed to be a clarion call for stimulus, and indeed an announcement that the clear and present danger to a creditor would be inflation, but nobody seemed to think that, at least not, you wouldn't think it the way the yields were structured. From 1946 until 1981, irregularly but persistently, interest rates rose. There were some astonishing mileposts. 1958 was one. I was just a kid. I was 40 years old. I barely had my... but in 1958, for the first time in anyone's memory, bond yields came to exceed equity dividend yields. Bond yields topped stock dividend yields the first time. Formerly, stock yields have been higher than bond yields. Why? Because equities were a junior claim on the capital structure, and people were mindful of what happens in bankruptcy. In bankruptcy, equity is relegated to a very subordinate position if it survives at all, and people had the memory, intellectual and muscular, of the affairs of the 1930s. In Harry Truman's case, the all too vivid memory of his losing his business in 1921, 22. So the world in 1958 said, what? This is most irregular and apparently most unsound. Stock dividend yields have traded through bond yields, but bond yields kept going up because the United States seemingly was dead set on creating enough dollars to guarantee domestic prosperity, even at the cost of some inflation. And indeed, inflation there developed. So the next sighting in our odyssey of interest rates is 1964. 1964, August of 64, comes a little tiny incident in the Gulf of Tonkin that was to have great geopolitical reverberations. Destroyer sailors aboard the USS Maddox or Turner Joy thought they saw enemy PT boats in their radar. They may or may not have. In any case, there was gunfire, there were reports, there was the threat of war. There was a war called the Vietnam War. In that month, Treasury bond yields, I think, printed, the 4 1/4s of 1992 printed about par, 4%. They didn't see that again until only recently. Interest rates went from 4% on long-dated securities to 15% in September 1981. 15%. You should have been there. It makes no sense, does it? 15, this is the Treasury. This is the Treasury of the United States. It was then AAA rated. That's how long ago this was. Equity-like returns with no equity risk. 30 years, 15%. Who wants them? Would anyone here care to take a guess how popular, knowing what you know now about muscle memory and about the unreliability of experts, who thinks that anyone wanted to buy one of these dogs? No, you're listening. Nobody wanted one, right? Of course, that's the way of the world. That's the way of the world of investing. People know the last thing. They are not sufficiently alert to the next thing. That's the glory, the wonder, the bane. It is the opportunity. But the market always gives you another chance to be wrong. To be right. Market always gives you another chance. It's called a retest in technical jargon. So September 1981, Mr. Market, that manic depressive, invites you, the investing public, would you not like equity return, no equity risk, 15%, 30 years non-call? Please, it's yours. No. Now, a couple of years pass. Paul Volcker, the now sainted Paul Volcker is running the Fed. Money is very tight. The CPI is rising year over year, about 4%, as it was not so long ago in this country, right in our era. But there is a fright in the bond market. There's a muscular memory fright. The bond market sells off, and the great and the good pundits of the day, including no less esteemed an economist than Milton Friedman himself, predicted that rates would go back up to the old highs and higher because, said Milton Friedman, money supply was growing too briskly. Huh? Bonds then were yielding, in the spring of 1984, were yielding 13 7/8%. The CPI was printing 4% year over year, almost 10 percentage points of real yield, if you please. 30 years not call, 13 7/8. Who wants them? Very few. Okay, so interest rates peaked in 1981. They have been going down and down and down and down and down until, why now? 31 years down. Okay, here's the value proposition. The 10-year note of no longer AAA U.S. Treasury for 1.98% before tax. Who wants them? Why? Everybody, right? Everybody, because rates have been going down for 31 years, excuse me. The 30-year bond, formerly offered without takers at 15%, then at 13 7/8, then at 12, 11, 10, still nobody wanted them. The 30-year bond is now offered at 3%. What a great deal. The inflation rate is rather higher than 3%, depending on which rate you use. The world is undeterred. My great good friend Paul Isaac, who is not only a very fine investor, but also an aphorist, calls the current state of play in the government securities markets of the world. You've heard of risk-free return, phrase used to describe treasury bills and the like. My friend Paul Isaac now talks about return-free risk. That is a quick overview of the world of long-dated securities. It is a most interesting historical spectacle, is this world. You know, when you're at it day by day, if anyone in here has traded interest rate products, as they call them professionally, you have gotten along fine throughout your career, I dare say, without knowing about the eternal cycles of interest rates. But if you stand back for a moment, as one ought to do in school, one ought to stand back and think about trends and think about history. It is, I hope, helpful to realize that what we take to be writ, what we take to be received truth, what we take to be clear, demonstrable, compelling, institutionally acceptable value might be just the opposite. It happens, indeed, it happens all the time. So that was one topic I promised you, and interest rates seemed like a good thing to start off with. Now, I don't know if you have seen that issue of Grants, John, in which we talked about single-family houses. That was the current issue. I'm not going to dwell on the arithmetic or the value proposition in current single-family houses too much. I will go over it lightly. This, of course, is interest rate related. Naturally, it is a capital asset. It requires, mostly it requires some long-term financing. What we at Grants try to do, and sometimes successfully, often not, is to imagine the next thing, having studied the last thing. We try to as much as possible, detach ourselves from the enthusiasms and the morbid terrors of the moment, and to ask and to try to answer, how will the world see us in 5 or 10 years? What's the smart thing to do now? What is the collective and unprofitable thing to do? We try to stay away from the latter and try to pursue the former. Or the former and the latter. I've forgotten which came which. We try to be smart. Single-family houses strike me as an asset class that is in strong contention for that class of asset most despised by most people in this country. Think about the pain and suffering and disappointment that single-family homes have dealt to people you know, and perhaps indeed to yourselves. Think of the accumulation of bad decisions that led us to this sorry past. I mean, can you imagine these people at the Fed, how they didn't see this? I mean, most of them they're high school graduates, all of them, many of them went to college. I think professional economists. They didn't see 1 ounce of our troubles in the horizon. And our troubles were measured in short tons. And now, of course, they got all these regulatory powers. They're supposed to know everything. But housing, I will leave it at that. I submit to you that housing is a not popular investment asset. And that is not the place to end an analysis, but it's certainly not a bad place to begin. If it's obviously great, it is obviously not a buy. I have a somewhat checkered record as an investor, but I tell you that one of the things that I've learned about myself is that when I really hate something, I'm about to buy, but no, I must buy it. That is the thing to do. And when I just am carried away with enthusiasm, which I have contracted from others, that is a bad place to begin. So you want at least to have contrary opinion on your side. You want to see an investment candidate that has many things going for it, not least that it is not held in popular esteem, which implies a likely favorable or attractive entry point so far as valuation is concerned. Now, as you will see in your prayer book dated February 24th, we wrote a story called Block Trade. And Block Trade describes the investment proposition that a certain Aaron Adelheit is offering to his limited partners. Aaron Adelheit is a refugee from the hedge fund world. He did rather well in hedge funds. But he realized, did Aaron, that when buying publicly traded securities and selling them, he was up against David Einhorn and Stan Druckenmiller and all of these people, and George Soros and his organization. He was up against people who had much fancier information and much more computing power. So Aaron asked himself, how can I have an edge? What can I bring to the investment table that will be different? And he looked around and he decided that maybe houses were the thing. Now, I illustrate Aaron's epiphany with a story about my friend Jimmy Tisch. Jimmy Tisch is the scion of the Lowe's fortune, and he's a son of Larry Tisch, one of the great investors, the late Larry Tisch. Jimmy Tisch runs the Lowe's Corporation, which is a diversified insurance and ... company. And one of the dots in their portfolio, maybe it still is, but it used to be offshore oil drilling, diamond offshore. Jimmy Tisch was attracted to diamond offshore during one of the many periods of depression in the oil and gas business. Oil and gas is hugely and ruinously cyclical, as you know. One year it's $150 a barrel, then the next year you can't give it away. And owing to these cycles, from time to time, capital goods are available for a song. So Jimmy Tisch, always open to a good contrary story, decides to take an invitation of someone he knows and to visit an offshore drilling rig. And I've never seen one myself, but apparently they are massive structures of rusting metal. But in this case, to Jimmy, the rust was much less impressive than the functionality and the sheer size. And it was being offered to him for very very low price. And he tells the story, he says, I looked to my left. I saw this immense thing. I looked to my right. I saw more steel. I looked up. I couldn't see the sky. I looked down. He said, all this for $3 million? So that was his back of the envelope analysis. Aaron Adelheid, in thinking about single-family houses, had a not dissimilar epiphany. He has done most of his investing in the still growing Southeast. And around Atlanta, he goes to these housing developments where houses once traded for $200,000 with 99 or 106% leverage. They are now offered for $50,000. And by the way, going lower. And he said, you walk inside them, you look at them from the outside, all this for $50,000? So it's an intuitive, it's a right-brained perception, but he's penciled it out, as you'll see in these numbers. And he gets a gross yield, very gross yield, something like 16% on prevailing Atlanta yields. And he saws that in half to allow for what he hopes is a realistic depreciation schedule. And he has undertaken the ever so granular work, has Aaron, for example, of mowing lawns. And do you know the worst thing that you can have happen to you if you are an investor in single-family houses in one of these partially occupied developments? What's the rookie mistake you must not make? Is not answering the mail from the Homeowners Association. Aaron has learned that at his cost, but he has come to be a great steward of these houses. He buys them, he fixes them up, and he rents them. And the rental yields are compelling, much, in multiples of the yield available on even the better grade bonds. And he has the psychic income, does Aaron, of knowing that he is part of the solution of what is not, after all, an intractable problem. This is a problem that has to do with the price mechanism. And I sometimes think, and I think Aaron does as well, that if our masters in Washington would let prices clear, let the so-called overhead trade, we could get on to the next thing, which is not deploring our condition of life on Earth, but rather getting on with our lives much better. So we have, at Grants, we have been looking at houses. We sent one of our reporters down to Florida to look at waterfront property, which is also available for severe discounts from the top. Not to say that's a bargain, but we think it's compellingly cheap. We've sent reporters to the coast of Maine, and one of our themes is the compelling absolute value available in residential real estate. So that's that. How about a macro topic now? I promised you a little bit on China. We think that China is a disaster in the making. Not the entire Chinese enterprise, but the Chinese economy. We hold this opinion because of the never before seen ratio of capital investment to national income. Astonishing capital intensive economy is China's. The trouble with a capital intensive economy is not that there shouldn't be capital investment, on the contrary, there should be. The trouble is the mispricing of the assets being stuck in the ground. And you get mispricing when you get the manipulation of interest rates to unreasonable levels, and when you get a central bank suppressing the value of the currency or manipulating the value of the currency. With respect to the banking system in China, the very unsystematic banking system in China, I commend to you a book called Red Capitalism, which came out, I guess, last year. There's a new edition in the making. And I want to, the authors are Carl E. Walter and Fraser Howey, H-O-W-I-E. This is it's a book of revelations, I'll tell you. I was a close student of the debacle in Texas during the 1980s. The Texas savings and loans went broke in astonishing numbers. Actually, not so astonishing when you consider the underwriting discipline of the Texas bankers. But I'm going to say, and this is how bearish we are, I'm going to say that the Chinese banking system rivals in its unreality, its willful unreality, and in its insistent incompetence. It rivals the Texas S&L loan business. That's how far I'm willing to go. What happens in China, according to Red Capitalism, is that capital allocation is dictated from on high. We talk loosely, some of us do, about China being a partially capitalistic economy. Well, no. The party tells the banks to lend to the state-owned enterprises, write the authors, but it seems unable to tell the state-owned enterprises to repay the banks. So what you get are cycles of bad debt, astonishing ratios of non-performing loans to loans outstanding, which then these loans are recycled into asset management companies, which are in turn recapitalized. And the Chinese economy will then run into a cyclical downturn to which the party responds with yet new waves of lending and new waves of fixed investment. Well, I won't belabor the point. I think that the anecdotal signs of excess in China are all around us, from these empty shopping malls to emptier office buildings. I think the difficulty in China at bottom is the difficulty of our central bank at bottom, which is a seeming indifference to the price mechanism, but rather an insistence on running affairs through the regime of command and control. So it's not that China is unique. What is unusual about China is the degree to which decisions are taken from on high, and capital decisions are taken without regard to the proper allocation of resources through the price mechanism. China is illustrative. It is not, sadly, unique. Another word or two on the macroeconomy and on regulation. I was reading a book the other day on the history of French finance in the early 20th century. And I came across what to me was a most remarkable and noteworthy fact. And this fact is that until from the time of roughly the Napoleonic monetary reforms around the first few years of the 19th century, 1803, until about 1925, 30, 35, the French government had nothing at all to do with the larger banks. There were no state bank examiners, there were no reserve requirements, nothing. The banks were run for their owners, for profit, and it was hoped that they would be solvent. If they were insolvent, why? That was the owner's problem, it was not the state's problem. It strikes me that there is much to be said for this, given that so many of the European banks these days are not just functionally insolvent, but quite literally insolvent, or would be except for the serial intercessions of the state. I had asserted to you before, proposed to you before, that progress in finance is cyclical. That is to say, we can't help ourselves but reenacting the tribulations and the errors of those who came before. It seems to me that we have lost so much by our ignorance of what has come before. I'm not sure if you saw in this morning's Times, on the business page, there was a story by someone who said that the Republicans, in their condemnation of the Obama stimulus program, in their critique of the auto bailout, in their stone throwing at the TARP program, the Republicans failed to tell us how they would have done anything better. Would they have done anything different? No, they should not be saying these things, because we had to do something. We had to intervene. So said the Times. And the Times cited as its authority a poll of 40 economists taken by the Booth School at a place called the University of Chicago. It's the first I've heard of this institution. But these 40 economists were in utter agreement that we couldn't do nothing. Now, I don't know about you, but if 40 economists agreed that today was Wednesday, I would check the calendar. So skeptical am I of this assertion that doing nothing is the very worst thing to do that I'm writing a book on the subject. In fact, in preparation for research in this book, I have founded the Warren G. Harding Society in New York City. It's a small organization, but with a lot of spirit. And we had our charter meeting just a couple of days ago in which we toasted the memory of the man who not only inherited depression, but also cured it. He cured it. Harding was president for less than 3 years. He died in office. He was sold down the river by his crooked friends. But what he did was most remarkable, and seemingly, to judge by the New York Times this morning and by the consensus of every right-thinking and respected economist, what Harding did was literally impossible. When he came into office, a great post-World War I inflation was ending, and a great, sudden, and quite scary deflationary collapse was beginning. Now, Ben Bernanke, our Fed chairman, talks somewhat glibly about deflation. What he means by deflation is the price indices not going up by 2% a year. That's his idea of deflation. Like a 1.5% inflation rate, that's the Fed's idea of deflation. I want to tell you about real deflation. This was 1920. Wholesale prices fell by 40%. Consumer prices substantially, perhaps 15 or 20, I've forgotten the exact number. Industrial production down 14%. Nominal GDP down double digits nominal GDP. Unemployment, imperfectly measured, went from like 2% at the inflationary peak to 12%, 12 or 14. What did the government do? What it did to meet this terrible threat nothing. What it did to meet this terrible black, cyclical downturn, a really ugly one, what it did was to balance the budget and to raise interest rates. Now, Paul Krugman, tell me, why did that depression ever end? Why are we still in it? That's the topic of my book. I think it's the most interesting, unanswered, indeed unaddressed question in American economic history. Why did this truly brutal depression come to an end in the face of a Fed interest rate that went from 6% at the cyclical peak to 8% at the cyclical trough? The only time in the history of the Fed that the trough interest rate was higher than the rate at the peak. There was a terrific liquidation of everything, as you can imagine. I mentioned the future president, Harry Truman, lost his business in Kansas City. Farmers got wiped out. And then what happened was even more interesting. After the cyclical bottom and the terrific violence of the collapse in prices and income and nominal activity, what happened then was a most powerful recovery. Famously, the 20s roared, right? The roaring 20s, they did roar. And within a year and a half or so, unemployment was back down to 3%. Now, I'm sure you know kids in this campus who are despairing of getting work when they get out of here. This depression, or recession, rather, is gone. What was it? 2007 was the top? It's 2012. It's 5 years. So it seems to me that the contemporary economic theory is missing something about what might be styled perhaps the inherent dynamism of a properly functioning market economy. Is it not possible the price mechanism is truer, that economies are more dynamic and more resilient than those who would intervene and give them credit for? That's my working hypothesis in this work. So I am all in favor of at least investigating the possibility the next time around of constructively doing nothing. But I did promise you to get rich. I'd tell you this, and I think it's only fair that I wind this thing up with something tangible you could take back. And although I confess to you, this has not been a great day for predictions for me. I was told by my ace assistant at my office that in Bloomington today there would be 30 degrees and 9 inches of snow. I dressed in heavy woolens. And I opened my iPad after I got on the plane, and I'm a big gold bull. And gold is down $60 today because the Europeans only printed $700 billion last night. This has been a bad day, except for you. It's gotten better since I came to IU. So it's, I give this by way of warning and disclosure that what I'm going to tell you might be all wrong just because today is what? I say it's Wednesday? Yeah, just because today is Wednesday, it might be all wrong. But I want to tell you about a couple of investment ideas that I think might flow more or less logically from the premises I have laid out. My premise is that the currency experiment of the past 40 years, however it might have worked, however favorably it might have seemed to work at intervals, that it is groundless on theory and still less substantial in historical precedent. That our paper money experiment is bound to come a cropper. It is coming a cropper. And that we will have a different monetary regime. When I got out of school in 1970, I guarantee you that nobody in the arts and sciences economics faculty was talking about the coming 40 years and counting of fiat money in America and the world. That was not a topic on the final exam. So I propose to you that the currency system is on short time, or at least is deeply and fundamentally flawed, and that I propose to you now that individuals anticipating the restoration of something resembling sound money will beat the authorities to the punch by collecting, accumulating gold and silver at prices perhaps higher than those in place today. That's my thesis. So I'm going to give you some ideas on how to implement this idea, if it's any damn good at all, which we'll know more, ladies and gentlemen, in 10 years. I'm going to give you the ticker first because where I come from, sometimes people all they want to know is the ticker. That's all. It's ticker. Don't let that guy be you. More than ticker. The ticker is P as in Paul, AAS, as in Pan American Silver, PAAS. And it's, as you might infer from the name of the company, the silver mining outfit. Actually, you can infer that from, it's Pan American Silver. And there are 104 million shares outstanding. Price had been 27. It's probably like 19 now or something. I don't know. It surely had a bad day. Market cap is about $2.5 billion. It's traded on the NASDAQ exchange. Now, this company was, I think, started in 1994 by a guy who thought that the silver price, then about $2 or $3 an ounce, would be coming into its own. Silver price is now about $33 or $34 an ounce. So he was right. And Pan American Silver, not to be confused with the defunct Pan American Airline, Pan American Silver went out and built 7 profitable mines. Now, mining is a hard business. It's a brutally hard business. Most complex. Yet they did this. They brought the bin more or less on time and under cost. So they are good operators. And furthermore, they are good capitalists. They own enough stock so that it really matters for them what happens. And I think uniquely among precious metals miners, the Pan American board recently authorized share repurchase. They thought their share price was too low. Now, that's either a good thing or a bad thing, share repurchases. Depends on the level of the stock price and depends on the motivation of those who would repurchase. But I take this to be a sign that whatever happens to this company, the management at least is on your side, and that's no small thing. Now, Pan American Silver is, in the day, it was a growth stock. They were increasing production at impressive rates. The market cap of the company was rising, and the price-earnings ratio, the median price-earnings ratio for the first, until fairly recently, was in the 30s. Big growth stock. Then Pan Am stopped growing. Their silver production pulled back, the growth rate pulled back. They produced less silver in 2011 than 2010. But they are developing new mines. They have made a new acquisition that was met with certain mixed reaction on Wall Street. But so much of what has disappointed people in the stock, it seems to me, is compensated for by the valuation, selling at about 7 times trailing net income, which for a well-managed, which this is, and profitable, which this is, and utterly unleveraged, which this is, mining company, is a most unusually cheap valuation. There's net cash on the balance sheet to the tune of about $400 million. $2.5 billion market cap, 400 odd million in net cash. And there is something like a very cheap call option in a mine, an envisioned mine, as opposed to an operating one in Argentina called Navidad. And Navidad is in the development stage. There's questions about whether the Argentine authorities will allow it to be developed. The company thinks that it will go forward, and if it does, it will, as they say, transform the volume of production. So the market is, I think, focusing on what has been, in the case of Pan Am Silver, rather than what might be. I regard silver as kind of a second-tier monetary metal, but still a monetary metal, and one that is likely to inherit some of the sheen of gold if monetary events take the course I expect of them, which is a hard left turn into a ditch. So here, what have I done? I think I've run through the entire checklist. I've helped to improve the administration of the universe with my macroeconomic suggestions. I've told you about clear and present danger in China. I've told you to buy a house. I have highlighted the exceptional competence of the French regulatory authorities when they didn't exist. And I have limbed the long cycles of interest rates, and I've deplored the state of our monetary affairs. Ladies and gentlemen, that's what I got. And if there's time or two for a question, I would love to not answer it. So, John, that's it.
Sir? You mentioned that 100 years from now, 50 years from now, they may look at the last 50 years or so as centrally planned economies around the world. Do you think that, when do you think that, do you think the tide is turning from kind of Keynesian macroeconomic theory to something different?
I hope it is. I can't say that I believe that, that I can see something like this. I think I told you a moment ago about the University of Chicago poll having to do with the Obama stimulus program and how the economists were all for it. The University of Chicago also polled 40 bright lights and asked them whether a return to something like gold convertibility of the dollar would be a constructive step. Not only did all 40 think it was a really bad idea, but they frankly laughed at it. A little hurtful. And if that weren't bad enough, Larry Summers said that 10 days ago, he said he was giving a talk at the 92nd Street YMCA in New York City. He said, gold standard? Why, that's the creationism of economics. Larry, what we have is a pure paper standard. Do you like what you see? So I do not see, alas, to me, alas, something like a critical mass of revulsion against the pretensions, I say pretensions, of those who would intervene systematically, constantly, and as if, as if they knew what they were doing in our economic lives. Britain is an especially interesting case in point. I think the British economy is within 4%, is not even within 4 percentage points of where it was in 2007. They are on quantitative easing program number 4 at the Bank of England. They have recently taken an attempt at reining in public spending, but nothing they have done in the way of massive intervention in Britain has done anything in the way of constructive support of activity there. I don't know. I wish I could say that I saw a new day coming. I do not.
Yeah, but do you think it's beneficial for, a guy like Ron Paul, who probably won't get elected, but who subscribes to the Austrian sort of theories of economics? doing sort of a service and trying
Oh,
to
yes.
at least educate.
I think it's terrifically heartening, and I gather that Dr. Paul gets a rousing reception on college campuses, and the young people are open to some new ideas, think that what he is saying, that he made it up, it's new. It was new. But if I were first vice president of the marketing department of the restoration of classical economics and of a financial system in which the owners of financial institutions got the downside as well as the upside. If I were the first vice president in charge of the marketing department for that regime, I would go after the defenders of the status quo, and I would say, how can you people, in this day and age of these social collaborative networks, how can you insist, how can you keep a straight face when you talk about the Fed imposing a funds rate through the deliberations of these 15 or so characters, these government employees? Why should they, what do they know? Why not, how about a wiki monetary system we should call the gold standard? So the gold standard is in fact, paradoxically, is a system based on the price mechanism and based on individuals acting as individuals and as economic units to exchange their currency for gold or not, for nations to run deficits on current account or not, and for exchange. Anyway, so it's a system that is quite elegant, but its elegance is based upon the lack of central direction and upon individual choice. So it's like kind of like Facebook money. So I like that. But the system in place is, to me, is the anachronism. It is the system of decisions made from on high and being imposed, and then when the decisions don't work, being redoubled or being, so we go to QE1, we get QE2, we get
Right.
Operation Twist, and there aren't enough people asking fundamental questions about what is and is not theoretically, intellectually, and historically defensible, it seems to me.
Thanks.
Yeah.
I was wondering if you might expand on something. You said, we might be witnessing a return to like a commodity-based money as gold or silver. I was wondering, do you see that happening as like a voluntary government admitting to wrong, or is it something that people would just spontaneously adopt through a great market mechanism?
I think you're seeing some. My preference would be that the United States government announced that the dollar will be convertible on a date certain in the future, and organize it as a national effort. But states are doing it, and of course individuals are doing when they exchange their dollar bills for coins that are coin dealers. I think that the gold standard is a wonderful way for economies to organize themselves and for the world to organize itself. The gold standard, fixed exchange rates, well, when they were in place, called the 100 years between 1815 and 1914, the world had never seen so great an expansion of trade, nor so great integration of economies as occurred during that century, nor so great a dynamic experience with technology and with material progress. So my impulse and my prejudice would be to try to recreate what worked rather than try to invent something which is untested. Is there that?
Sorry, but so the trades that we were talking about, in the 1920s, 1920s, weren't they all just basically European colonies or European countries trading with their colonies, right? So in some cases you could go. So I mean, like it's a little different now with a lot more sovereign nations.
Oh, I think there were plenty of. I mean, Europe had no. Intra-European trade was, of course, there was no colonial trade intra-Europe, and it was astonishingly vigorous and unimpeded. And just compare that with what followed after World War I. There was the gold bloc. There was the Austrian, German currency and customs union. There was the balkanization of Europe, starting in almost in the 20s and certainly in the 30s, Bretton Woods was a regime of control. It was a regime of capital controls. It was a regime of government suppression of many prices. And in recent years, trade has been liberalized. And of course, colonialism has gone out of style all over the world. But I don't think you can characterize the great advances in trade and material progress in the 19th century as a colonial experience.
Yeah, I'm just curious. I'm really looking forward to your book coming out. I can't wait to read it. But I'm curious, what were some of the key differences that you found between the recession of Harding's time, where doing nothing was very successful, versus Hoover and Mellon and the regime
Yeah.
liquidated everything and then having a protracted depression?
Well, that is a wonderful question, and let me answer it as people are accustomed to doing on college campuses by citing an author and a title. There's a book called America's Great Depression by Murray Rothbard, and Rothbard contends, I think with a great deal of success, not with, I think he didn't persuade everyone who read this book, but what Rothbard contends is that Herbert Hoover, far from duplicating the laissez-faire approach to the Depression that characterized the Harding administration in 1920 and 21, that Hoover was actually the author of the first New Deal, that federal intervention in 1930 and especially 31 succeeded principally in retarding America's exit from that downturn. And Robert Higgs, another libertarian-minded historian, makes the same point in some of his works. Herbert Hoover was an irrepressibly energetic and well-intended, he was a humanitarian of the first order, and he did his very best to mobilize the government to lead efforts to do things like, in 1930 and 31, to hold wage rates up. Now, one of the features that characterized the Depression in 1920-21 was that wage rates actually declined, as did prices. But if prices decline and wage rates don't, you are not only inviting unemployment, you are making it inevitable. And with every good intention, Hoover stuck sticks in the spokes of the price mechanism, and I think was responsible to a degree for the duration and the depth of that depression, and but I don't think he was responsible exactly for America's slow climb out of it. America didn't get out of it until 1946, and maybe the reason was that capital went into hiding during the 1930s for any number of reasons, but principally perhaps because of the policies enacted by Roosevelt. But I don't pretend to have all the answers on this yet. I started working on it a few months ago, but I am intrigued that, like Ben Bernanke, for example, is meant to be the world's leading authority on the Great Depression of the 1930s. And from this depression, he has extracted policy lessons that we live with today. The quantitative easing, operation this, operation that, suppress the funds rate, 0% interest rates. All of this follows from his determination not to be the Eugene Meyer of the Fed of the 2000s. Eugene Meyer was Hoover's Fed chairman. Chairman Bernanke, why only this preoccupation with that depression? Have you not looked at the one before that actually ended? To me, that is America's greatest depression. I mean, they call it the Great Depression. How about a depression that begins and ends within 18 months? That to me is pretty fine. I mean, we've got 4 kids who are in their 20s. I think they would like it if this ended. So I don't. Again, I would like the discussion to be not so centered on the 30s, which it has been since 2008. The 30s. Well, that was one episode. We have many more.
I wonder if you'd let me play devil's advocate, and I'm doing that because I agree with virtually everything you've said, but this is something that crosses my mind when people talk about returning to the gold standard. It seems to me it's a bit of an empty hope, because the essence of what's wrong is not so much that we're on or off a gold standard, but the essence is that we trust government to put in populist policies that are meant to quickly eradicate apparent harmful situations. And Nixon was able to remove us pretty easily from the gold standard, and there's nothing to prevent any politician in the future from removing us from a gold standard or some other similar standard when it looks like a popular thing to do in order to remedy the problem. So I would argue the problem essentially is not the gold or not the gold, but the problem is really bad government policy, and that the real gold standard is in education. When people understand the message that you've given, and that is that classical remedies are the only ones that really work, then governments cannot mess up the economy with or without gold.
Yeah.
So
Well, that
to
might
me,
be-
as education, it's not metals.
Yeah. Well, we can have both.
Yeah, that's a good answer.
Yeah. The gold standard, I should have said by way of introduction, is never to be confused with the Garden of Eden. This is a human contrivance. It's perhaps the least, I think, history would demonstrate it's the least imperfect monetary contrivance that we humans have yet settled on. To your point, it is notable and ever so discouraging that the system that worked so well for so long was swept away in August 1914 and never brought back. So the systems that followed in the 20s were awful. I mean, these were brutal. The 20s and the 30s and the 40s, yeah. Why did we do that? Well, we did it because, I don't know, we did it. So yes, if we did grasp the gold ring and return to the gold standard, we could go off it again. But I think the diagnosis of our present difficulties through the lens of a classical monetary structure might be helpful. And I think that what made the gold standard work was not just the nature of the currency or the collateral behind the currency, which was a big part of the disciplined public finance that we saw for much of the past, until fairly recent decades. But what made classical arrangements work was the clear delineation of who owned what in the world of finance. I think the indefensible and truly ugly feature of present-day Wall Street is that, to the 1/10 of 1% goes the upside, and to we the people comes the downside. The Occupy Wall Street people, so muddled in my opinion and so much, had that basic notion. There's a horrible inequity in our semi-socialized banking arrangements. Citicorp is a ward of the state. This is no business being in business. Until 1935 in this country, there was something called the double liability rule. And under this rule, the stockholders of a failed bank got a capital call. So if you're the stockholder in Citibank, and if it hit the wall, or if it became impaired in capital, the sheriff would come to you if you didn't answer the lawful call in your capital. They come to you and say, all right, we see you own 100, you're a shareholder of 100 shares of record. You owe, as basis of par value, you owe this. And those funds went to the restitution of the claimants on the estate of the bank or to restore its capital. And it was a fairly effective system. They did raise money when money was least available to be raised, right? But to me, the import of that law was not even so much how it worked, but rather the philosophical statement. The philosophical import of the law was that it's your bank. It's not the people's bank. It's not the government's bank. Okay, you get the dividends. You make sure it's capitalized. You make sure it's liquid. Manage it. To me, it was a capitalistic system. What we have now is, I think, an abomination. And anyway, so end of speech.
Is the euro and the Eurozone going to survive?
The Eurozone will certainly survive. They've survived so much over thousands of years. But I think the euro will, I don't think so. So this morning at 5 o'clock, if you were paying attention to your Blackberries, at 5 o'clock came news that the European Central Bank had announced the successful subscription to its offer of unlimited funds for its banks, 1% rate of interest for 3 years, that 520-odd billion, I think, of euros had been subscribed. Now, do you wonder where they got the euros? Where do you find that many euros, just that one day? Where do you get them? Well, the PC, yeah. So I said to you many times, I guess, but certainly an hour ago, sometimes it's a useful exercise to say, what will our grandchildren say about this? Is it not possible they'll say, and you believe that? I think they will say that. I think, is it somebody over here? Anyway, I think not.
Yeah, one quick question. In the global economy, you see a lot of countries trying to depreciate their currency to kind of make their goods cheaper on the global market. How do you sell, and that kind of simulates the local economy, how do you sell to individual countries to go on a commodity-based
and not do that?
Which has been appreciating like that without selling them all?
So it's a great question. Further to the premise of your question, I mean, the Swiss, the Gnomes of Zurich have made it quite clear that they will not suffer an appreciation of their franc, and the Swiss National Bank is doing the most muscular of press cranking interventions to make sure the Swiss franc doesn't appreciate against the euro. They want to protect commerce in Switzerland, not just the franchise of the Swiss franc as a port in a storm, and it turns out there's a storm in the port. They don't want that. They want a living economy, not a museum of money. That's fine. But just as you say, kind of a strong currency is the old maid of the world of world monetary affairs. I guess the way to sell the opposite, the way to sell stability, is to simply invoke the historical record that when the exchange rates were fixed and when currencies were exchangeable into a universal measure of value, and when there was no reserve, critically, when there was no reserve currency like the dollar or the pound lording it over the others, in that system, on form, on the record, the economy did great. Your economy did great, ours did great, the world did great. That worked. This doesn't work. That's a sales pitch.
So the collateralized sort of monetary system is dependent on the sort of the fixed exchange.
Yes, that's part and parcel of it.
Okay.
Yeah. Well, yes.
Question. If we move to a gold standard, do you think that the controllers of interest rates would then be gold mining companies instead of the Fed? And if so, why?
What makes gold an especially suitable, a uniquely suitable monetary asset is that the above ground stocks are hugely in excess of any 1 year's production. So, from the time of Cleopatra, somebody's probably walking around this campus with, in his or her molar, there's a bit of a Cleopatra ring or something. The stuff is never destroyed. Gold is never destroyed. So if one's monetary material were copper or oil or corn or something, those things are consumed. In the case of an agricultural commodity, a bad crop year would be a monetary event rather than an agricultural event. The output of gold has tended over time to increase, over the past century, to increase about 1.5% to 2% a year, about the rate at which population grows, about the rate at which productivity increases. It's a sensible rate of increase. There has been about 1 ounce of gold per person in the world for a long time. So the gold miners are not really going to have the whip hand. Interest rates will be determined by other forces, perhaps market forces. But the gold mining companies will really not have much to say about the monetary regime. They will do what they do, but they won't be the Ben Bernanke's of the new regime.
So you don't think there's enough supply under the ground to really have that much of an effect?
I'm sorry, there's not enough?
You're saying that there's not much gold left that is not yet discovered to really have an effect on interest rates. Is that what you're saying?
one can't be sure, but that seems to be the case. It's very hard to find. That's another thing that makes it a good monetary asset. Just it's hard work to find it, and it's hard work to extract it, and you can't just, as it were, print it. Anyway, thank you. How nice.